It's a new trading week, and we continue to see plenty of action across the financial markets. Joining me this afternoon is Peter Cardillo of First Standard Financial. Peter, thanks for joining me today.
To be back.
Well, this is our first interview since the surprise presidential election and victory of Donald Trump. So I do want to get your take on what we've been seeing in the markets. But in terms of investors out there, should they be diversifying away from the bond markets?
Well, let's recap of actually what happened last week. And of course, everyone was surprised at the Trump victory. Of course, there were those who were not. But let's say the market was taken by surprise. And of course, on the night of the elections, when the situation began to unfold that Trump was probably going to be the next president of the United States, we saw the markets actually plunge. And then, lo and behold, in that morning, while the indices were indicating a decline of about maybe 2 or 3% on the averages, we saw a quick reversal. What happened? Well, obviously, institutions got caught on the wrong side of the market, and they were forced to cover their shorts. But not so much cover their shorts, but also to rebalance their portfolios to a pro-growth program that Mr. Trump has embarked upon. And so if you see actually what happened, we saw NASDAQ actually lag. We saw the S&P, although moving higher, really didn't make new highs. The rise in yields, if you look what's happening in the bond market, over $1 trillion was lost since the Trump election, since the Trump victory. And as a result of that, once that money begins to dry up, I think then the market begins to focus on higher interest rates.
And speaking of which, we have plenty of Fed speeches this week. And of course, we have that December Fed rate decision. Of course, if we look at futures prices for Fed funds, we're seeing a higher likelihood of a rate hike. But in the long term, what can we expect from a Trump presidency?
Well, I think, if he sticks to his pro-growth program, I think the market will do well. But I want to caution that in the first year of a Republican victory, traditionally, the markets run into a bump road. And that's because that, the unwinding of certain programs by the Democrats take hold, and that could be a negative for the stock market in the short term. But then after that, it usually is a positive outcome. And so I kind of think this time around, the situation is a little bit different because we have low interest rates that are now running up again. That is, yields are running up again. And most likely, next year, and of course, I do expect a rate hike at the end of December, but next year, there's a good possibility that rates may have to go up by about 0.75 of a percentage point. So which means we could see by the end of 2017, the Fed funds rate close to 1.5%. And of course, that's the difference, and that's going to be a little bit of a problem for the stock market.
And Peter, very quickly before I let you go, oil prices, where do we go from here?
Well, oil prices are lower, and that's due to the fact that the market just doesn't think that OPEC is going to come up with some sort of a deal to cut production. And so it's a question of supply and demand. But I kind of think that the market is going down because the market wants to force OPEC to come up with some sort of a deal. And if that happens, we'll see oil prices turn around rather sharply.
Okay, Peter. Well, thank you so much for joining me at the beginning of this week, and thanks for your insight.
My pleasure.